Welcome to Dads and Dollars podcast with your host, Stanley Funches, certified financial planner, business owner, author, speaker, and father of three. Listen as Stanley shares his valuable insights around fatherhood and finances gained from over 20 plus years of experience. You'll hear stories, lessons learned, and the ups and downs he and his guests have encountered on their journeys as fathers, professionals, and business owners. These shared lessons will help provide you a path for financial independence while celebrating the challenges of being a dad. Thank you for joining the conversation. Here's your host, Stanley Funches.
Good day. Welcome to Dads and Dollars, a podcast where the perspective of fatherhood and finances are woven into many life topics. My name is Stanley Funches. I am a certified financial planner by profession and a father of three in this thing called life. We are glad you can join us for season 1, episode 4. And on this episode of Dads and Dollars, we're going to discuss inflation, this market dropping, and as a dad or a parent, what's it like when your kids actually get grown? So we're going to start off and tackle the subject of inflation. And hopefully we will do a better job on this subject than the Federal Reserve is doing at this moment. So what's inflation? So Webster's dictionary of inflation is a continuing rise in the general price level, usually attributed to an increase in the volume of money and credit relative to available goods and services. So start off and say a continuing rise in general price level. So there is a normal pace of inflation. Inflation is not a bad thing. The opposite is deflation, and that means prices are going down, and that's not good for the economy or our economic structure at all. So there's a natural level of price increases that will happen, that will continue to happen. It's just the fact that it's not normal at this particular point in time. The continuing rise is at a higher rate. So I'll tell you, the long-term average rate of inflation is about 3.24%. Okay, long-term economic average. Over the last 20 to 30 years, that number has been about 2.5%. Okay, so we received reports in May, and the annualized inflation rate was 8.6%. And the report before that, it was 8.3%. So you can see that inflation at the annualized rate at the moment is 3 times greater than historical, nearly 3 times greater than historical average. So that's a problem. And that's something that had to be addressed. And so we're all feeling this level of inflation very much. We're feeling it at the gas pump. We're feeling it at our price that we go to the grocery store and we buy eggs. And we're feeling it even more so in things like chicken wings, right? I mean, and this should disprove the stereotype of chicken wings for sure, because we all are absolutely loving chicken wings because the price tells us that. I remember in college, back in the 90s, we could buy a pack of 12 to 16 chicken wings for like $3 or $4. And that would feed us for 3 or 4 days. But I went to the grocery store just last week and I saw that same pack of chicken wings and it was $19. So again, we all must be loving it, and the prices are going through the roof, and we are feeling this level of inflation in pretty much everything that we do. So it's important for us to deal with inflation because, from an economic standpoint, it's a huge negative. It's a negative on long-term growth. We lose purchasing power as inflation rises. We buy less things. Things cost us more. And it hurts the low and fixed income recipients even more because they don't have the ability to have the wage increases to keep up with the pace of inflation. And ultimately, we can't survive. Our economy won't. We fall into these third world statuses if we keep the same pace of inflation that we have today. So the Fed has to take a look at this, and they have to take aggressive action. So why does it happen? Why does inflation happen? And so go back to the definition. It says usually it's attributed to an increase in the volume of money and credit relative to available goods and services. Okay, so we know we've had the shutdown and COVID from 2020 to even now to a certain extent, and the federal government provided a lot of stimulus, passing out checks to corporations, business owners, families, in order to get us through that economic shutdown. So there was a lot of stimulus, again, to increase the volume of money. So the volume of money just increased. The same thing happened in 2008, 2009 as well. And it says it increased the volume of credit. All right. So the Fed lowered interest rates basically down to nothing. And so made borrowing very easy. So not only was there more money in the system, but borrowing became very easy as well. And we can see that in our home prices, right? More people went out and bought homes because they can get these interest rates that were very low. And so that lowering of borrowing also impacted inflation. Okay. And lastly, it says to the available goods and services. Now, this is something that from an economic standpoint, the Fed nor the government has a lot to be able to do with this. The supply chain disruption through the COVID definitely made the available goods and services contracted. So you can see the volume of money increased, credit relative to goods and services that definitely increased, and the available goods and services decreased, which made a perfect storm for us to be in the point where we are seeing reports at 8.6% inflation. So what can be done about it? The Fed their mandate is to control, stabilize prices, not to necessarily stop price increases, because that's not going to happen, because over time prices will continue to rise, as we just said before, because we want our economy to grow. But they need to stabilize the prices. They have a mandate of full employment, and we are sitting pretty much at full employment now, which is a good thing. So how are they going to stabilize prices? Well, they do this by raising interest rates. They have many mechanisms to raise interest rates. We're not going to go into all of those, but they raise interest rates, and that helps stabilize prices because it takes, it's a tightened monetary policy. Well, if we talked about the definition of inflation, which is, increasing in the money supply, increasing in credit available. Well, if I tighten monetary policy, I raise interest rates, I'm taking money out of the system, and I'm also not giving people the incentive to borrow, because now borrowing costs so much. People aren't going to go out, and businesses aren't going to go out to borrow as much. So they're hoping to take care of those two mechanisms by taking money out of the system by raising rates and dissuading people to borrow money. And that will help control the price and give us some price stability. So that's what the Fed is trying to do. And they're going to continue to do this until interest rates come back to a more normalized level. Now, will they get back to 2%? I mean, a lot of people are doubting it, but they're trying to do this without throwing us into a recession. But that's going to be a very tricky thing to do. Most people are expecting that we will have some recession, some level, some form of recession for some period of time, if we're not in one already. But that's the Fed's goal, and they have to control inflation. So we have to keep our eye on it. So what do we do? How does this impact us? How does it impact your daily life? So I will tell you a couple of things, for your family members, or if you're retired, or if you are looking to retire and you have pension and Social Security, and that's going to be a big part of your long-term inflation will impact you negatively. That's going to be a big part of your retirement. So you need to make sure that you're planning for a long-term look at inflation, because your income may be fixed. So you want to make sure that you are very conscious, if this is your primary source, pension and Social Security, that you're very conscious of, your spending level, as well as the impact that it will have for you in the future. Now, if you're an investor and you're investing in your portfolios, do not abandon asset allocation. Bonds have not performed great this year. It's because when interest rates rise, bond prices fall, but bonds tend to be where you go to balance the risk in your portfolio. So don't run away from bonds. Just look at trying to control your maturity in your bonds, meaning that if you have a bond mutual fund or you have bonds and they're long-term bonds, maybe you should start looking at shorter-term bonds. Shorter-term bonds are not impacted as much when interest rates rise as the longer-term bonds. So again, don't ban an asset allocation, but at the same time, look at the bonds within your portfolio and how it's made up and see what might be best there. Continue within your portfolio. I know that does sound like something natural right now with the market dropping, but you have to realize that stocks, mutual funds that are based on stocks, and exchange traded funds that are based on stocks are some of the leading things that help us when inflation persists for a long period of time. Right, those values tend to increase, and those are assets that we want to have in our portfolio. So we have to understand what that balance is for you with your asset allocation. When you're picking stocks or mutual funds, use those ones that use what we call fundamentals. They are investing in companies that earn money, that pay good dividends, that over a long period of time show consistent earnings and market share. So research your mutual funds, research the type of exchange traded fund you might use or the individual stock that you may use, and make sure that they have characteristics of earning good money, having great market share, consistent earnings, that they have pricing power. And they also, if they do pay a good dividend for a long period of time, that might be something that you might want to look at as well. So within your portfolio, those are things that you can do, but you also want to think about what type of assets that you're holding outside of your portfolio. So over a long period of time, different real estate holdings tend to do better over a long term. So if you're into real estate, now right now prices of real estate, they're high, the valuations are high, but it may be something that you save up to do as those prices might come down here as we go, if we go through some type of recessionary time, that you take advantage from a long-term perspective and own real estate. Because again, in the short term, we don't know what's going to happen in the next 6 months to a year, but over a long period of time, if inflation persists, real estate tends to be a great place to be over a long period of time. So investigate those things as well. If you are retired, one of the things that you might need to look at doing is, if you have a parent or someone who's retired, maintain equities throughout retirement. Again, that is where your growth might come from, just depending on what the time frame is. So just make sure you're evaluating that. A lot of people want to run away and say, hey, gosh, I don't want to have any stocks in my portfolio or anything stock market related within my portfolio, or mutual funds that own stocks in my portfolio. I don't want to do that anymore. I'm retired. Well, if inflation continues to grow, then that might not be a winning strategy for you. So evaluate where you are there. If you're a business owner, check your service level, increase the value that you provide to your clients, your customers. Increase the products that you provide, gain market share within what you're doing. So you can also have some type of pricing power as inflation continues to rise. You want to make sure you're delivering an increased level of value in what you're doing, because your inputs, the things that you use, whether it's your wages, whether it's things you do to build your products, those prices are going to go up. And so you have to make sure you're providing tremendous value. For everyone, every household out there, control your spending. Save aggressively, because if inflation persists, you're going to need to have a higher level of cash reserves. For those who are preparing to retire, if you're 5-10 years out, you also want to look at revisiting your retirement plan. What I mean by that, a lot of times we're forecasting what retirement looks like, right? You're saying, okay, if I save X number of dollars, I'm going to be able to live off Y number of dollars for a certain number of years. Well, that's good if you had that type of analysis done, but what inflation rate did you have that analysis completed at? If you were working with someone or you were using an online calculator and you were using 2% inflation of your current expense level, then I can tell you if inflation ends up being 3 or going to 3.25, that makes a big difference in your retirement forecast or whether you can retire comfortably. So if you're working with a financial planner or if you're doing an online calculator, you're doing it yourself, go back and revisit your plan and make sure that you're still on track with your level of savings to live the lifestyle you want at your expense level, because the cost of living, $10,000 today a month will be greatly higher in 10 years at the current level of inflation. And if the current level of inflation increased from the 3% average to the 4% average, it'd be that much more. So it's going to cost you more to live. It's going to cost you more of your assets to create income for you to live. So you need to go back and revisit that plan. Inflation is a big deal. So let's keep our eye on how successful the Federal Reserve is in containing it, while also preparing ourselves for an environment of higher inflation for a longer period of time than we have experienced the last 30 years. So what's going on with this market? So let's examine that. The S&P 500 index, which is widely considered by most of the media outlets as the market. So when you are watching TV or you're reading the paper and they talk about the stock market, they're typically talking about the S&P 500 index. And what that is an index that tracks the largest 500 companies in the United States. And over the last few years, let's try to look at some of the numbers here. We started 2020 and that index value was 3278. So then we went through the pandemic, and right, that index value dropped during the pandemic, but then it started to rise again. So when we began 2021, that number was 3793. Okay, so we had an increase from 3278 to 3793, even though we were in the midst of the pandemic. We finished 2022 or 2021 and got to 2022. That number was 4573. So again, we've gone from 3278 pre-pandemic to we closed at the beginning of 2022 at 4573. Now, in that time, we also hit an all-time high in November of about 4743. All right, so keep that in context. And if we look at today's numbers, well, on June 24th, the market closed at 3911. All right, so we go back 2022, 3278, 2021, 3793, today, 3911. Now, of course, we did hit those highs of 4573, 4743. So what we've seen is the market go up very rapidly, and now it's come back, not all the way back to the January 2020 levels, all right, or the 2021 levels. Now it's kind of touched on those a little bit, but it's come back some, but it hadn't come back to the point where we're at the levels of the pandemic valuations. So I just want to put that in context for you so you can see that, yeah, even though the market has dropped from those highs, beginning of 2022, we were at 4573. Even though we've dropped, we haven't dropped below the levels of before the pandemic. Now, so this is important for you because I want you to understand about investing. Investing, one of the key components and drivers of your return is time in the market and not necessarily time in the market. We got a lot of people say, I want to get out. I want to get out. You can't get in and can't get out. I mean, that's just, those are not the winning ways of investment, especially when you're excited about investing when the market is high. We get a lot of calls and people want to invest at And the market's in the 4,000 range, 4,500 range. They want to invest. They want to put money in the market. And then when the market drops to the range that we're in now, they're like, oh, I want to take my money out. Well, we can't do. It's very difficult to win in investments when you're buying high and selling low. So it's time in the market, not time in the market. On Motley Fool's website, they have a chart that says from January 4th of 1999 to December 31st of 2018, that if you missed just the 10 best days in the S&P 500, your performance was half than somebody who stayed invested the whole time. So if you got in and out, and no one knows when those 10 best days are. So the more prudent strategy is to stay invested. Another thing I'll tell you, and I use this analogy quite often because people understand real estate and houses. So if I bought this house on this property, and I really did, I thought the location was great, the house was great, and I was gonna own it forever, and I may rent it out a little bit, but I wanted to keep it, right? And let's say I paid $10,000 for this house, and then so I paid $10,000. I'm happy about it. I enjoy the house. I think that it's going to be a great investment property. I don't live there, but I just really like having the asset. Then somebody comes and knock on your door, a week later and says, "Hey, I'm gonna give you $5,000 for that house." What would you tell them? Many people will be like, "Man, get out of here. I love my $10,000 house. I'm not gonna sell it to you for $5,000. I got this for a reason. I got it for the long term. I'm gonna get some rent off of it sometimes. I may, sell it sometime in the future, but I'm not gonna sell it today because I don't need it today." Then somebody comes and knocks on your door and say, "I'm gonna give you $3,000 for it." Okay, you paid $10,000 a few weeks ago. Now this person coming in and want to offer you $3,000 for it. At that point in time, you may laugh initially, but probably what I'm gonna do is say, "Man, where are they selling houses like mine for $3,000? Because I loved my house at 10. I truly love it at 3." And so maybe then you go out and try to start buying some of those houses that people are selling for $3,000 if somebody's willing to do it that's similar to yours. Now, if somebody came and offered you $12,000 the next day, after that guy offered you 3, lady came in and offered you 12, you probably still wouldn't sell it. You would feel much better about your house. You'd be like, "Oh, okay, now somebody's offering me 12. I paid 10 for it. I feel good about it." But you still probably wouldn't sell it. So here's my point. The analogy is that's what the stock market is. So you buy a piece of a mutual fund, or you buy a piece of a stock or a company, you own some shares, and you always own those shares until you sell them, right? Just like the real estate property. I own those shares. It's just on the stock market every day throughout the day, and every closing day, somebody's knocking on your door and telling you, "Hey, I'll give you this." And it may be less than what you pay, or it may be more than what you pay. You just get it publicized. No one really comes knocking on your door for real estate on a daily basis. So we don't know what those values are changing day by day or year by or month by month. But on the stock market, it's priced daily and sometimes intraday throughout the day is priced. So we always constantly getting those knocks on the door if we're looking and seeing what those things are worth. And we can't get emotional about it because we bought something just like the house that we bought in the corner location that we thought was great. And we paid 10 grand for it. We wanted to hold it for a long period of time. That's the same way we got to think about these shares of these companies that we believe in and that we bought, or these mutual funds or exchange traded funds that we believed in that we bought, and we hold them for a long time. So this is how I would want you to kind of think about when these market declines happen. And if they get really deep discounted, just like the $10,000 house that somebody came and offered me 3, that deep discount, then I'm gonna start wondering where can I buy more, right? All right. So what you should start doing now when the market is starting to go down. Now, from a planning perspective, one of the things I would tell you to do, like if you have IRAs, and you might want to look at converting some of those. If you're high income and your tax bracket, you talk to your tax accountant and say, "Hey, can I convert some of these IRAs into Roth IRAs?" Just because Roth IRAs give you the ability, even though you're going to pay taxes now on that money that you convert, the prices of the values of your portfolios may be down a little bit. It may give you the ability to have money tax-free in the future. So you pay taxes on it now, maybe the Roth recovers, the IRA recovers the investments within it, and you would be able to have some tax-free growth that you could take out later. So from a planning perspective, that's one of the things I would tell you to kind of look at, especially if you're in a high income area and you've saved money in IRAs and you might want to start doing some level of partial conversions. That's just something to look into. Talk to your accountant, your planner about that. But from an investment standpoint, you need to sit back and confirm your goals. What's time frame for this money? What's your time frame for the dollars that you have? When do you need it? It's a very important question. Now, if you need it in the next 6 months or a year, then you need to evaluate whether you need to take some money out or whatever. But if it's 10 years that you need it, then you need to go ahead and define that for yourself so you can make sure you have appropriate investment strategy for your dollars. What type of income or dollar amount you're going to need when you do whatever period of time you need to use those dollars? What type do you of income that you're going to have? How much will that be? You need to define that for yourself as well. You need to look and say, all right, if I need X number of dollars, I need to put this in cash and get it outside of the market. If you need it within the next 6 months, year, 2 years, I would say even a 2.5, 3 year time frame. You have goals that are 2.5, 3 years out. Maybe that's something that you need to evaluate and say, do I need to hold it in cash or some cash equivalent? You need to evaluate your risk tolerance, right? So how much volatility are you willing to withstand? There are different ways to value and measure your risk tolerance. You need to take those exercises and see, are you a growth investor or are you a safe investor where you want your money to be in bonds and cash? You need to evaluate that for yourself. And then when you got your time frame, you got your goals, you evaluate your risk tolerance, then you develop what we call a proper asset allocation. And that's the mix of stocks, bonds, foreign, small companies, large companies, real estate, other type of investment. That's the mix that's within your portfolio. You can look at your current risk and see if it's in alignment with your risk tolerance. So you scored your risk tolerance, and now you take a look at the current risk of your portfolio and make sure that those things are in alignment. That's a very key part, because if that's not in alignment, you want to get that matched up, because maybe you're seeing more volatility in your portfolio than you actually need. So you want to make sure you line those things up and adjust them if you need it. But be patient. Investing can be very, very emotional. And typically the people who control their emotions in the highs and the lows are the most successful. Warren Buffett has a great saying. He said, the stock market is a device which transfers money from the impatient to the patient. So be patient in this market. So something hit me the other day, and I was thinking about it. I was like, okay, I always wanted to be a dad. I mean, I can think about earliest memories probably around I was 10 years old, and I was like, I want to be a dad. I want to have 3 kids. I want 2 boys. I want a girl to be the last one. I mean, I always wanted that. It was just like something I envisioned as a kid. I said I wanted to have a career where I could stay home as they grew up. Like I could be home with them as they grew up. One of those reasons was my dad worked at night. He worked at night, and I saw the toll that it took on him with him working at night. But he was very insistent about it because my mom worked during the day. He's like, I want somebody to be home with you guys when you come home from school, or home with you in the summertime. And so even though he might have been asleep or resting, he was there. And we knew that he was there. And so I wanted to kind of emulate that. Again, like I told you guys, my dad has been an inspiration to me. And that's one of the things I want to emulate, have a career where I could be home. Then the other thing that further shaped that is the 1980s sitcom Growing Pains with Alan Thicke. I know a lot of people, when you think 1980s sitcom, you probably think, okay, the Cosby Show may have shaped them, and it did to a certain extent. I mean, to a large extent. it shaped a lot of what we thought might be possible. But for me, the growing pains, I was like, Alan Thicke, he's a psychologist. He has his practice at home and he's there with his kids. Combine that with my dad, I was like, boom, that's what I want to do. So actually, I went to college and I started studying psychology in high school. I went to college to be a psychology major. Didn't work out so well. I decided to go into business and do financial planning, which all of that really helped because, being a financial planner also has its moments where we're helping people with behavior and thoughts. But I digress. So that was kind of how my childhood was shaped. I wanted to be there with my kids during the day. I wanted to see them grow up. I wanted to watch and coach their activities, and just in a way, try to say, okay, here are some things that I had when I was a kid to make sure that they, some things I didn't have to make sure that they had. And so those were my thoughts. But then one thing happens. They grow up and they're no longer little kids anymore. Now they're young adults and I have to be a father for young adults. I never envisioned that. I realized I don't have a plan to be a dad for young adults. It was never in my mind, like what to do when they get to be, grown people living their own lives. So that's why we're here today to talk about, what are some of those things and challenges as your kids actually become grown. So they start to have similar issues. I just noticed on the phone with them that they're having similar issues to things like I have, whether it's work, whether it's relationships, whether it's the cost of living, or we're talking about their successes and failures. And these are all real issues, so many different issues than when they were kids, right? Where we can just say, hey, dust yourself off and keep going. I mean, these are real life issues from an adult standpoint. And so having the capacity to the emotional capacity as a dad to not only know what I'm going through and I'm dealing with, but also be there for them is a great bit of challenge. And I think, having a game plan for that is very important. They also got the issues of the day, right? With social media, which is very new, not something that any of us probably envisioned, 20, 30 years ago, but they have social media and you have to help and talk to them about that. And then all the social and political unrest and the climate that we're in right now is very demanding for our young kids. And so our young adults, I'm still calling them kids, but our young adults. And so how do we help them navigate those things when we're dealing with those things as well? Each one of them are so different. And they are, even though each one of them have a strand of me in them, of how I do things, whether it's good or bad, they're all very different than me. So what I may want to do or what I may think may be very different than what they are. So I just try to, help them along the way. So here's some of the things that I'm trying to do. And I would love to get you guys input. And at the end of the podcast, we'll tell you how to give your input. I want them to have their own lives where they're doing their own thing and encourage them to seek their vision and throw my experiences in there with them so that they could understand where they're going and what they're trying to do. So encourage them to love and support each other because at the end of the day, mom and dad, we're going to be here, but they have a connection with each other where they can understand each other and have more empathy with where they are in life, their stage in life and what they're dealing with, then probably we can to a certain extent. So we have the experience, but they can have the empathy and love and care for each other. And they know where they came from, what their family's about. And which is another thing to keep them grounded and taught in what they were taught, being kind to people, find what you love and do the best you can at it, keep striving to be good at it. Also, I want them to also understand that there's a faith that they have to have, a faith in God and how he's blessed them and what and what they can accomplish because of those blessings, and how they're empowered to be the best that they can be within what they have, but also know that God can guide them as well. And just at the end of the day, be there to listen. I got to do a better job of listening. I am a big talker when especially it comes to them, but at this stage of the game, for them, it's better for dad to be a better listener. And so those are some of the things that I'm trying to work on. So again, I don't have a plan at this stage, and hopefully through the course of the podcast, we'll meet and talk to dads that'll help me develop a plan to be a better father at this stage of life, because I never thought about this before. So if you would send us a note about some challenges that you're experiencing or that you have experienced as your children become actually grown, not acting grown, but actually are grown, and what's your plan? And if you haven't gotten to that point yet, you can send us a note at askdadsanddollars.com. That's dads in with the letter N, dollars.com. All right, so that's it for our podcast today. I hope you got something out of it. I hope you enjoyed it. And if you did get something positive out of it, please give us 5 stars. And if you, like the elders say, if you don't have anything good to say, then don't say anything at all. We'll see you next time on Dads and Dollars.
Thank you for joining us for this episode of Dads and Dollars. If you found the information shared today valuable, please share with your friends and family via your social media. If you have a request for a future financial topic for Dads and Dollars, please email us at ask@dadsanddollars.com. For further information on your financial journey, you may purchase The Quest for Financial Independence, 10 areas of your financial planning you should not ignore, by visiting our website, dadsanddollars.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to make a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Asset allocation does not ensure a profit or protect against a loss. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investing involves risk, including possible loss of principal. Guests and their companies are not affiliated with or endorsed by LPL Financial or Intellis Advisory Group. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through Intellis Advisory Group, a registered investment advisor. Intellis Advisory Group and Intellis Wealth Management are separate entities from LPL Financial.